Hey, welcome back. The benefits of a 5 to 10% put position for your portfolio coming into the new year. Your portfolio has had a stellar year. Congratulations. But here's the question. Are you prepared to keep what you've earned? Today I'm diving into one of the smartest strategies seasoned investors use to lock in gains while protecting against uncertainty. What is it? A 5 to 10% allocation to put options against a highly appreciated portfolio. This move isn't just tactical. It's really a masterstroke in managing risk. Let me explain why. The case for portfolio protection. First, let's set the stage. After a year of robust returns, your portfolio is likely overweight in some of the strongest performing sectors or individual stocks. While that's fantastic, it also makes you vulnerable to market corrections. Historically, post-election years and the beginning of new economic cycles often come with heightened volatility. Think about macro uncertainties, potential Fed pivots, and geopolitical risks. A 5 to 10% allocation to put options acts as a safety net. Think of it as portfolio insurance. Now, you're not betting against the market. You're not doing something unpatriotic. You're ensuring that unexpected drawdowns won't wipe out your hard-earned gains. It's about playing offense and defense. The math behind the allocation. Why 5 to 10%? Well, here's the logic. A well-structured put position with an appropriate strike price and expiration can provide outsized protection relative to its cost. For example, a $100,000 portfolio might allocate $5,000 to a portfolio-wide ETF put. Let's say SPYDER, SPY, or the triple Qs, QQQ, targeting a strike price 5 to 10% below the current market level. If the market were to dip 15 to 20%, the small position could appreciate by 200%, 300%, or more, offsetting losses on your long holdings. This asymmetric payoff allows you to keep the majority of your portfolio invested for long-term growth, while a small percentage hedges against the downside. That's convexity in action. Timing and implementation. Now, when should you execute this strategy? Coming into the new year, implied volatility in the options market can be lower, making it an opportune time to buy protective puts at a reasonable cost. Look for expirations 3 to 6 months out to cover the most uncertain part of the year while balancing cost effectiveness. Target broader indices like the S&P 500 or NASDAQ for diversified protection, or even high beta sectors where your portfolio is most concentrated. This ensures your hedge aligns closely with your risk exposure. A mindset shift for investors. Here's the most critical part. Allocating to puts isn't a sign of pessimism. It's merely the hallmark of a disciplined investor. Too many people see hedging as an unnecessary cost when markets are calm. But here's the truth. It's during the good times that you prepare for the bad. Think about it this way. You don't buy life insurance betting that you're going to die, although that's exactly what you are doing. By protecting against tail risks, or even things that exist between the tails, like a 10% drawdown in the market, you reduce emotional decision making and ensure that you stay invested without panic. Isn't that what we're all aiming for? A calm, confident approach to building wealth? So is your portfolio prepared for what's next? Take a close look at your holdings. Consider whether 5 to 10% put position might be the smartest move you make as we enter the new year. If you want more strategies like this, subscribe to the channel. Turn on notifications. Let's make 2024, and more importantly, 2025 and beyond, a year of calculated, confident investing. This is where smart money learns to stay ahead.